Halfway through the week, and bulls seem to keep getting what they want. Of course, this morning's PPI having a negative in front of it helps. Our big picture conversations with Kevin Gordon this afternoon, a senior investment strategist at Charles Schwab, joining us to take us into the bell. Kevin, good to have you. Today's big highlight, inflation part 2. Does it just totally eliminate the possibility of another hike for us?
For now, yeah. I mean, I think if you combine, softer retail sales report today, even though you had an upward revision to the prior month, plus the PPI with a negative sign in front of it, as you mentioned, and then CPI yesterday, that collection of data is at least enough, I think, to reverse some of the fear that had kind of seeped in a little bit in the prior month, where you started to see, some kind of ruptures in some of the inflation data, whether it was in the shelter component or some of the goods components. So at least you're reversing a little bit of that. And then you have the confirmation on the PPI side. The one thing that I'll note, I mean, it gets a little bit more nuanced because the Fed has been a lot more nuanced in what they're looking at in terms of the PCE data, is if you map over some of the components within PPI that are directly correlated or directly related to that PCE core services ex-housing component, that was a little bit stickier. So it doesn't necessarily, I think, make the case that the Fed needs to hike again, but probably that the metrics that they're tracking still look a little bit sticky. And as some officials have been mentioning, most notably and most recently, Mary Daly today, they just don't want to, be too soon to declare, okay, the hiking is over. We can, start to think about rate cuts. I think that discussion is probably still a ways off for now.
Do you think that their idea of rate cuts is the same as the markets? Because the market's idea of rate cuts seems to be, if inflation comes down, they can cut rates. But the Fed has told us that that would only happen if there's some degree of employment or economic stress. Is there still a gap in between that logic, or might the Fed just cut if inflation keeps coming down?
Well, keep in mind, too, I mean, as you turn the corner into 24, and not just because we are turning the corner into 24, it just happens to be we're on this trajectory right now where, the balance for labor and inflation, so the dual mandate for the Fed is coming more into balance, kind of clearer into view, where you have a little bit of weakness that's starting to broaden out a little bit on the labor front, whether you look at labor force participation starting to sag just a little bit. You've still got cracks in some of the payroll data. When you go industry by industry, manufacturing's been weak, even if you take away the UAW strike data. And the reversal of that information's been weak. Financial services to some extent has been weak. And then you look at just the move in the unemployment rate. 3.9% historically is low, but the move off of the low is a 0.5 percentage point increase. So if that momentum is sustained to the upside and you have inflation coming down, maybe that's more of a support for the Fed to ease a bit. But at the same time, the market pricing right now for relatively aggressive cuts in the middle of next year, or maybe the early part of next year, that's a little bit different. I think that the Fed probably still wants to be a bit more surgical or a bit more nuanced in the approach of cutting rates, because we also have to keep in mind that as long as you have disinflation continuing to build, and if they hold rates steady where they're at right now, that just means real rates will continue to go up. So even if they cut a little bit and you still have pretty significant disinflation, you probably keep real rates at a relatively elevated level.
Okay, so they could have some motive then to just kind of trim down a little bit, do a small cut or two, even if there's no breakage in the economy.
Yeah, it could be. And, also keep in mind that typically when they're done hiking, they're in pause mode. And if we're going to go based on, the past few hiking cycles, the past few interest rate cycles, the first cut has been relatively aggressive and then they kept going from there. Obviously, that was in the face of a recession. So if you get a relatively mild downturn, or if you get a continuation of what we've been calling kind of the roll through of the recession in some of the sectors that we've been seeing, very possible that you could start to see some hits to labor in 2024, some more material hits that look recessionary. But if you have offsetting strength from areas that have already gone through their recession, whether it's on the good side of the manufacturing side, even housing, maybe that's enough of an offset for the Fed to look at that array of data and say, well, we don't need to be as aggressive as we once were. But, our thinking has been that even when we do get the next cutting cycle, because eventually we'll get one, the likelihood that the Fed goes right back to the zero bound is still pretty low. I mean, absent some sort of catastrophe and obviously a massive supply shock that they can't really control for, which, COVID would be one of those. Not saying we get another one, but that's the scale you need to be looking for them to go automatically back to zero. Absent one of those, it's probably not the case that happens.
Got it. Okay. Hey, Kevin, real fast. yesterday's move, today's follow through, does it change the breadth calculations in a favorable way for bulls?
Yesterday, I mean, definitely is a day that you want to see. I mean, we kind of been waiting for that since the advance off of the October 27th low. Just the overwhelming number of advancers relative to decliners, not just within the S&P, but the broad market. Even if you just look at the Russell 2000, it was the best that you had seen since 2014. So you're not going to get a cluster of those days, one day after the next. But I do think you need to see a follow through and at least some kind of cluster, maybe on a month by month or every other week basis. If you don't, and you still see headline indexes moving higher, but it's just, again, carried by sort of a narrow leadership or a handful of stocks and the rest of the market doesn't participate, that's a different story. But days like yesterday are great because you have that good combination of good economic data and then basically all of the market participating too.
All right. Good stuff. Thanks for the perspective, Kevin. Always appreciate it.
Thanks, Oliver.
All right, have a good one. Kevin Gordon, Senior Investment Strategist at Charles Schwab. All right, with some good analysis there on what it might take for the Fed to indeed live up to the market's expectations.